With the week nearing its end, we note that the US core PCE rates have yet to be released and no deal at this point in time has been reached to avoid a US government shutdown, which could occur on Sunday. On a monetary level, we note that the BOJ is due to release its summary of opinions of its September monetary policy meeting on Monday, in addition to the Riksbank, which is also due to release its September monetary policy meetings on Monday as well. In regards to financial releases, we could start on Monday with Australia's final Judo Bank manufacturing PMI figure for September, Japan's Tankan Big manufacturing index figure for Q3, Germany's HCOB manufacturing PMI figure for September, the UK's final manufacturing PMI figure, Canada's manufacturing PMI, the US S&P final manufacturing PMI figure, and the US ISM manufacturing PMI figure, all for the month of September. On Tuesday, we note Australia's building approvals rate for August, Switzerland's CPI rates for September, and the US JOLTS job openings figure for August. On Wednesday, we make a start with France's services PMI figure for September, the Eurozone's final composite PMI figure, the UK's final composite PMI figure, US ADP national employment figure, and the US final composite PMI figure, all for the month of September, followed by the US factory orders rate for August and the US ISM non-manufacturing PMI figure for September. On Thursday, we note Australia's trade balance figure, Germany's export rate, which are both for the month of August, followed by the UK's composite PMI figure for September, the US weekly initial jobless claims figure, and Canada's trade balance figure for August. Finally, on Friday, we note that Germany's industrial orders rate for August, followed by the UK's Halifax house prices rate for September, the US non-farm payrolls figure, the unemployment rate, and Canada's employment data, all for the month of September. The US dollar is about to end the week stronger against the euro and the Japanese yen, but relatively unchanged against the pound. On a fundamental level, we highlight that the US government is facing the very real possibility of shutting down, and at this point in time, no deal has been reached to avoid a government shutdown, which has been touted to be as early as October 1st, which is this Sunday. On a monetary level, we highlight that Minneapolis Fed President Kashkari stated on Thursday that we might not be as restrictive as we think, implying that the bank may have to raise rates higher. Furthermore, Chicago Fed President Goldsby on Thursday hinted that he may be willing to consider another rate hike if there is a lack of progress on the price side, therefore providing support for the theory that the Fed may need to raise rates at least one more time before the end of the year. As such, we may see the greenback gaining against its counterparts as the hawkish rhetoric appears to be aiding in the dollar's ascent. On a macroeconomic level, we highlight that the US weekly initial jobless claims figure came in lower than expected, hinting at a resilient labor market in which it could potentially strengthen the case for the Fed to increase interest rates in its next monetary policy meeting. Furthermore, the increase in the US core durable goods orders rate, which was released on Wednesday, may have indicated a resilient consumer market, potentially further strengthening the dollar. However, other financial releases, such as the real consumer spending rate for Q2, came in at 0.8%, which is a significant drop compared to last quarter's rate of 4.2%. In addition, the pending home sales rate for August came in at minus 7.1% compared to the previous month rate of 0.5%, which tends to paint a different picture for the US economy, implying that the consumer base of the US may not be able to withstand further rate hikes, which could weigh on the dollar. Therefore, we turn our attention to the core PCE rates for August, which are due to be released later on today, which is the Fed's favorite tool for measuring inflationary pressures. In conclusion, we note that the greenback strengthening at the end of the week, yet traders may be awaiting the US PMI figures and the US employment data, which may provide greater insight into the resilience of the US economy. The pound seems about to end the week lower against the euro, slightly stronger than the Japanese yen, and relatively unchanged against the dollar. On a fundamental level, we note that Prime Minister Sunak on Wednesday announced a reversal on his climate change policy by announcing that the ban on the sale of oil and liquid petroleum gas will be pushed back to 2035. On a monetary level, we highlight that the BOE is set to create a permanent lending facility for non-bank financial institutions such as insurance and pension funds during times of stress, according to a report by the Financial Times. The creation of a permanent lending facility is aimed at stabilizing the financial system as a whole, according to bank officials, yet we beg to ask the question as to how will the UK government prevent the potential exploitation of the system by bad actors. In our opinion, the creation of a permanent lending facility, despite its good intentions, may be abused and exploited by the system, and as such, from a more long-term view, it may generate issues for the UK economy and government, thus potentially weighing on the pound. On the other hand, it could increase stability and generate increased consumer confidence in the UK economy, which over the long run could support the pound. On a macroeconomic level, we note that the GDP rates for Q2, which came in earlier on today, implied that the UK economy grew at a greater degree than what was previously anticipated, as the rate came in at 0.6% versus the expectation of 0.4%, which could potentially provide support for the pound. Lastly, traders may be looking at the UK's PMI figures, which are due to be released next week, in order to gauge how the UK economy has fared in light of the persistent inflationary pressures and high interest rate levels imposed by the BOE. The Japanese yen is about to end the week weaker against the dollar and the pound, but relatively unchanged against the euro. On a fundamental level, we note that according to Bloomberg, US and Japanese officials are warning that a group of Chinese-linked hackers are targeting companies based in the US and Japan. Despite no malicious activity at this time, should major companies be compromised, we may see the JPY weakening as the risks to Japan's financial industry could be brought into question. On a monetary level, we note that BOJ Governor Ueda stated on Monday that the bank's basic stance is that we must patiently maintain monetary easing, implying that the bank may not be abandoning its ultra-loose monetary policy anytime soon. Furthermore, the BOJ's July meeting minutes hinted that the bank may continue with its ultra-loose monetary policy, with its members anticipating that the Japanese economy is on track to recover moderately for the time being, and as such could potentially weaken the JPY. On a macroeconomic level, the BOJ's core CPI rate, which was released earlier on this week, indicated an increase in inflation pressures in the Japanese economy, potentially aiding to the bank's target to reach its 2% inflation target. Yet the Tokyo core CPI rates contradicted that view, as they were indicative of easing inflation pressures in Japan after coming in lower than expected, which could hinder the bank's objective of reaching its 2% inflation target. In conclusion, despite the JPY seemingly being poised to weaken further, we must note that the last time the JPY dropped to such levels, we saw government intervention in order to safeguard the JPY, and as such, in our opinion, the government may be preparing to intervene in the FX market, with such a move potentially providing support for the JPY. On the other hand, should we see no government intervention, we may see the JPY further weakening. Lastly, yen traders may be interested in the release of the bank's summary opinions for its September meeting, which are due to be released on Monday. The euro is about to end the week in the reds against the US dollar, the pound, and the Japanese yen. On a fundamental level, we note the escalating tensions between the EU and China, with the EU announcing a probe into the subsidies received by EV companies. The probe by the EU is meant to prevent unfair competition practices experienced by Chinese EV makers who export their cars to the EU in an apparent protectionist move. On the monetary front, we note the speech by ECB Halsman, who stated yesterday that it is unclear whether we're at peak rates yet, implying that the bank may have not reached this terminal rate. Yet, ECB President Lagarde stated on earlier during the week that rates have reached levels that, maintained for sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target, implying that the ECB may have reached its peak terminal rate. Despite the contradicting views, they both appear to agree that rates will remain at current levels for a prolonged period of time, which could support the euro in the long run. On a macroeconomic level, however, Germany's and France's preliminary CPI rates for September came in lower than expected, hinting at easing inflationary pressures in Europe's largest economies, which could weigh on the euro, as the case for further rate hikes may be diminishing. Lastly, traders may be looking forward to next week's PMI figures for the Eurozone, Germany, and France in order to gauge the impact of the current interest rates on the euro area. In the event that the PMI figures come in higher than expected, we may see the euro gaining support, as it may indicate persistent inflationary pressures in the economy and vice versa. The Australian dollar is about to end the week stronger than the US dollar. On a fundamental level, we highlight the agreement reached by France and Australia on the creation of stable supply chains for critical raw materials, further enhancing the cooperation between the bloc and Australia, which in the long term could boost the Aussie, as it may reduce its dependence on China for its exports, therefore being less exposed to volatility stemming from China. On another fundamental issue, China's embattled property developer Evergrande is facing serious questions about its future following reports that the company's CEO was under police surveillance. Should China's property market woes continue, potentially decreasing the nation's manufacturing activity, we may see a weakening in the Aussie due to the country's over-reliance on China for its exports. On a monetary level, we note that the RBA's interest rate decision is due next week, with market participants widely expecting that the bank is to remain on hold, with AUD/OIS currently implying a 90.87% probability for such a scenario to materialize. We tend to agree with the general market consensus that the bank may remain on hold during the next meeting, as the risks posed by China are still elevated in our opinion. On a macroeconomic level, we note a relatively quiet week for Australia in terms of financial releases once again. Yet we note Australia's preliminary retail sales rate for August, which came in lower than expected at 0.2%, implying that the Australian consumer may have less disposable income or is less willing to spend, and as such could indicate that the current interest rates are making their way into the pockets of consumers, which in turn may weaken the Aussie. Looking at next week, we highlight the Judo Bank manufacturing PMI figure for September and Australia's trade balance figure for August, which may be of interest to market participants. The loonie is on track to finish the week relatively lower against the greenback. On a fundamental level, we note that after Prime Minister Trudeau's accusation of India of being involved in the assassination of a Canadian Sikh activist on Canadian soil, it appears that tensions are escalating, with media outlets reporting on Thursday evening that Indian hackers took down the website of Canada's army. On another fundamental note, Canada traders may be keeping a close eye on oil prices, which are moving closer and closer to the $100 per barrel figure touted by market analysts as being a potential target for the commodity. Yet at the time of this report, it appears that the oil's price ascent may have been temporarily halted. Nonetheless, should the oil prices regain their upwards momentum, we may see some support for the loonie, given Canada's status as a major oil-producing nation. On a monetary level, we note that the Canadian Senate has proposed Bill S-275, which proposes the establishment of a monetary policy committee consisting of independent members who would be responsible for setting interest rates. In addition, the proposed bill would mandate the bank to publish a cost-benefit analysis of its interest rate adjustments on a yearly basis. The proposal is anticipated to fail to pass, yet underscores the rising tensions about the BOC's interest rate policy, and any hindering to the current status quo could, in our opinion, weaken the loonie, as the increased uncertainty could increase market volatility in the FX markets. On a macroeconomic level, we note that Canada's preliminary GDP rates for July have yet to be released at the time of this report. However, market participants are anticipating that the GDP rate will come in higher than the previous month. As such, should that be the case, we may see the loonie gain against the dollar, while should it come in lower than expected, we may see the loonie weakening. In our opinion, however, based on the rise of oil prices in the past few weeks, we anticipate that the GDP rates may come in higher than expected, potentially providing some support for the loonie. Lastly, traders may be interested in the financial releases stemming from Canada next week, with the manufacturing PMI figures for September, Canada's trade balance figure, and on Friday, the Canadian employment data. In the coming week, we expect higher volatility in the FX market due to the high number of PMI figures which are expected to be released during next week. We also note that in the US equities markets, all three major indexes appear to be continuing their downward trajectory as the week nears its end, possibly also due to the uncertainty created by a possible US government shutdown, which could occur over the weekend. As for gold's price, we note that it appears to be ending the week below the key psychological figure of 1900, yet with the possibility of a US government shutdown, it could potentially edge higher. Furthermore, we note that oil's price appears to be losing some momentum after aiming for the $100 per barrel figure, which has been touted as a potential target by market analysts. Lastly, the higher than expected reduction in the US oil inventories during the week, combined with the OPEC Plus production cuts being extended until the end of the year, appear to be forming a long-term view of elevated oil prices. In addition, the US SPR reserve, which is near its all-time lows, with the current inventories nearing levels last seen in 1983, could hinder the US government's ability to influence oil prices should they feel the need to do so by increasing the supply of oil in the market.
Can you guys hear me? Okay, should be fine now. Okay. But yeah, possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So, disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of this material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here is our agenda for today. So before we get into Elliott wave theory, I just wanted to do a quick recap on Fibonacci because you can't really get into Elliott wave theory without actually fully grasping your Fibonacci concepts. So because it's been a while since we've done our Fibonacci series, I thought we would spend a couple of slides to talk a bit about our Fibonacci techniques. Then we'll get into Elliott wave theory, look at the different types of waves, and a few shapes. So there are a lot of different shapes, about 50 plus if I'm not wrong, but I'm just going to be going through 3 or 4 in this session. Okay, let's get started with our Fibonacci now. So these are the Fibonacci numbers that we typically use. So if you've been with us before, you would know that we use 4 different types of Fibonacci. We use the Fibonacci retracement, which is the numbers that's in between, so 23.6 to 78.6. And then we have the Fibonacci extension, which is the 127 to 161.8. And then we have Fibonacci expansion, which is the negative 61.8 and negative 27.2. Okay, in this GIF that I've included here, we are just showing you the Fibonacci retracement, which is the most basic form of Fibonacci. Okay, I'm not sure why my projections GIF isn't showing up, but I will go into depth what exactly projections are in the later slides. So firstly, we can look at the retracements that I went through earlier. I mentioned earlier, only consists of a starting point and an ending point. So you can see the point 1, point 2. What's important to note about this is basically just to follow the shape of the chart. So you can see it's pretty clear shape, clear cut shape, and actually for all of the Fibonacci, we highly stress on following the shape of the charts. Next, let's take a look at expansions. So expansions are the negatives of the range of Fibonacci numbers that we use. So if we take a look at the expansions GIF here, you can see we have 3 points that we take note of, one starting point and then an ending point. So for expansions and extensions, these both use the Fibonacci retracements tool on TradingView and on MT4 as well. Only the projections one that requires 3 points, then we use the Fibonacci extension tool. So it's a bit confusing at the start, but basically these 3, we use the same tool, the Fibonacci retracement tool. So we have a starting point here and an ending point. And our third point is just to make sure that we retrace at least 50% of the chart. So typically expansions and projections are used together, and we want to look for a flash kind of shape. So you can see here in the chart, we have this lightning bolt kind of shape, or some people call it like a Harry Potter kind of shape. So that's what you want to look out for when you're using expansions as well as projections. But I'll give you a couple of examples later on. Next, if we take a look at extensions, this is what we call the Nike tick Fibonacci method. So we have a starting point and an ending point, which is the head of the tick. And then it has to retrace at least 100% of the head of the tick to be considered a tick. Obviously, the tail has to be longer than the head. So this is what we're looking for. Extensions, we use the more than 100% values of the Fibonacci range. Okay, let's take a look at a couple of examples in the charts so that's a bit clearer. So here, we have all of the three ranges for you to take note of. So from 0 to 100% is the range of Fibonacci retracements. Then we have the positive Fibonacci retracements, more than 100%. Not included here is the 161.8 as well. So it's important to take note of that if you are using the Nike tick. Next, if you see me looking to this side more, it's because my monitor is on this side. So yeah. And then on the other hand, with the negatives, it's our Fibonacci expansions rather. And this is the negative 27.2 and the negative 61.8. So let's start off by looking at the Fibonacci retracement method. So we have the starting point over here and the ending point here. And as you can see, I'm looking at where price has retraced, hence the name Fibonacci retracement. So over here, I've highlighted this area in which price has bounced off of. And this is the 61.8 area. So we take note of this level because price has reacted off of this specific level. So that's an important level for us to take note of. So what we like to do is once we've identified a specific level, because it can get quite messy if you're looking for Fibonacci confluence in which all of the different Fibonacci's line up in the same area. So what we do is once we've identified an important area, we just get rid of the other levels and just solely take a look at this one highlighted number. Here's another example of a Fibonacci retracement. So I have our starting point here, ending point here. My 38.2 is at this overlap support level at the 32544.21 level. So it's an overlap support because we have a swing high. We have a swing high that has that's at the same level as a swing low. So it's basically where the bulls and the bears respect a specific area. So at this overlap support, we also have the 38.2% Fibonacci retracement that lines up with that area. That's why I've highlighted it here. Okay, another example here. So here I have two levels that I've highlighted to show you guys briefly how we use Fibonacci retracements to support our resistance and support levels. Okay, so firstly, let's take a look at this 61.8 that lines up with my resistance at the 0.92637 level. So at this level, it's obviously a swing high resistance with the swing high highlighted here. And then using our Fibonacci retracement, I've noticed my 61.8 lines up with this level and price has reacted off of it nicely, which is why I've just kept that level. And then I pull out another Fibonacci retracement from this swing low to this swing high here in order to find a retracement level that lines up nicely with my swing low support. So this is a multiple swing low support with 1, 2 swing lows lining up nicely. This is at the 0.91614 level. Okay, so and then once again I can see that my 61.8% lines up nicely with that same level, which is why I've highlighted this area here. Okay, so I hope that's been pretty clear on Fibonacci retracements. Pretty straightforward method to use. So, but let me know if you guys have any questions throughout the webinar. Okay, if there are no questions, we can move on to our next Fibonacci recap. Okay. Okay, so the time frame, we typically will analyze on either the 1 hour or 4 hour time frame um, because the shorter time frames, like the 5 minute, 15-minute time frame, those tend to be a little bit more noisy. So we stick to the middle for 4 hours or 1 hour, depending on how clear the charts are. But it really depends on your own trading strategy. So if you are a swing trader, you might prefer a longer time frame. If you're scalping, you might prefer a shorter time frame. So it really depends on you, but we just stick to the middle whenever we are analyzing. Okay, so next, let's take a look at Fibonacci expansion. So once again, expansion, we are looking for a flash symbol or lightning bolt symbol. So you can see here, in the example I've included, we have a starting point over here at point 1, and then at point 2, we have the ending point. Point 3 is where we then start to analyze whether price has retraced at least 50% in order to form that flash or zigzag shape. So in this example, price has retraced up to the 61.8% level. So that's how I know it's more than 50%, definitely more than 50%. So I can use it to predict or to forecast where price is going to come down to. So I can see here, at my last arrow, I'm expecting price to come down to this negative 27.2% level. And I'm expecting price to bounce off from this level. And we've included support because it could be a possible support level. Okay, so for Fibonacci expansions, we are looking at the negatives, mainly negative 27.2 and negative 61.8. Okay, and then we can see the outcome of what we have analyzed in the previous slide. At the negative 27.2 support level, price really did bounce up nicely off of the Fibonacci retracement. Okay, and then a pro tip that we have included here is that price usually does come back to its ending point, which, as you see in the beginning, at point number 2, that's where our ending point is at. Okay. Next, we're looking at over here we're looking at the Fibonacci extension. So like I said, this is a really quick, just kind of recap before we dive into Elliott wave theory. But I just thought that in order to really understand Elliott wave theory, you really need to have your Fibonacci techniques in check. So it's been a while since we've done our Fibonacci series, so we're just going to do a quick recap here. But if you have any questions, feel free to let me know. Okay, so next we're moving on to our Nike tick or Fibonacci extension. So the extensions we're looking at are the 127.8, I think, and the 161.8. Okay. Um, Here you can see very clearly that we have an upright Nike tick. You can see exactly the shape of the tick, but it can also possibly be upside down. I think I have examples later on to show you guys an inverted Nike tick, but it's basically the opposite of this, but upside down. So it's like the head here and then the tail is longer. So starting point here, ending point here, we always want to make sure that we're looking for this V shape. And an important point as well is that you want to make sure that it retraces fully the 100% here. So it has to fully retrace it and go beyond the 100% starting point. So you can see over here in this example, it has retraced more than 100%, and it has moved up to this projected level at the 161.8% level. Okay, so it's at this 161.8% projected level that we are expecting a reversal off of this level. And you can see that's exactly what it did. So not included here is the 127% level, which would be somewhere over here. So once price has broken out the level, then you can expect price to reverse off of the 161.8. Before it reverses off the 161.8, you may expect it to either break out of the 127 or like it did here, or also reverse of the 127 level. Okay, here is a GIF to show you guys what I mean. Okay, so we can see here price is currently at the 127.2% level. Okay, so if you watch closely, price did kind of test this level a bit before breaking out of it. And then once it breaks out of it, then we can expect a really nice bounce off of the 161.8 level. Okay, so let me know if you have any questions on the three Fibonacci methods so far. If you are a little bit confused, let me know as well. But we cover all of these in depth in our Fibonacci series. So not to worry if you are a little bit confused, if you've missed those. I think we will probably do those again sometime soon. So yeah, you can keep an eye out for that. Okay, let's move on. So next we're gonna be taking a look at Fibonacci projection. So we have Fibonacci projection actually uses the Fibonacci extension tool and not the Fibonacci retracement tool like the other two um that we've like the other three methods that we've looked at previously. So this is because the Fibonacci projection uses 3 points that only the Fibonacci extension tool provides. So for Fibonacci projection, we use the 61.8, 70.6, and 100%. It's mainly those three, but you can also use the 127.2, 161.8, and the 200%. Okay. Pro tip, once again, for Fibonacci projection, we are also looking for a flash or zigzag kind of shape. So very often the projection and expansion tools, rather, the ones that both use the flash zigzag shape, those are typically used together to find a confluence area. Okay, now let's take a look at a couple of examples of this. Okay, so here's an example of a Fibonacci projection analysis. So we have a starting point here, middle point here, and ending point here. And you can see very clearly this flash shape. So this Fibonacci trend line, as I mentioned earlier, should follow price movement really closely. So follow the shape of the market basically. Okay, so in this other example, we have the starting point, middle point, and ending point, and we are projecting this price to bounce off of a specific level. So we can see here we have identified this 78.6% Fibonacci extension. And this is extension we're looking at. As I mentioned, always look out for the zigzags. And you can see price really bounced off of this 78.6% Fibonacci extension. Okay, so here is the before where we are using the projection, Fibonacci projection. So it's a little bit confusing because the method is Fibonacci projection, but we are using the Fibonacci extension tool that's on MT4 and TradingView. So as long as you remember that projection uses 3 points, I think you're good to go. So starting point, middle point, ending point, these are the 3 points that we're using. Remember this shape, this zigzag shape, and then the 78.6% Fibonacci projection that we are expecting. Then you can see price really bounced off of this 78.6% Fibonacci projection level. Okay. Next, let's take a look at another example. This is another kind of shape of the zigzag. It's inverted now. So we have a starting point, middle point, and ending point that follows the shape pretty closely. And then we are projecting price to hit the 100% Fibonacci projection. So we say that the 100% level is one of the most powerful levels because price is most likely to hit those levels. Okay, and you can see that's exactly what happened. Price reacted off of the 100% Fibonacci projection level, just as we expected. Okay. Okay. Now that we know how to identify um, some Fibonacci levels, let's take a look at how you know when is considered an invalid Fibonacci retracement. So when does a Fibonacci retracement become invalid? So one of the most common scenarios of this is when price makes a lower low. So if they're assuming you are drawing Fibonacci retracement from the top to the bottom of the picture. So as I showed you guys in one of the GIFs, price made a lower low from, or rather, we're drawing the Fibonacci retracement from the top to the bottom. So that's what we need. So an invalid Fibonacci retracement happens when price makes a lower low. So the lowest point or the ending point is no longer valid. So that's just basically what it means. So if there are bars on the right that break your ending point, it then becomes invalid. So there are Fibonacci retracements that are negative. So the negative 27 and negative 61.8 that we use for Fibonacci expansion. And we'll touch on these as they basically go beyond your ending point and yet they are still valid. So we already talked about those in a couple of the slides before. So here's an example of an invalid retracement. So you can see the starting point here, ending point here, as I've highlighted. And because price has broken below my initial ending point, it then becomes invalid. Okay, as long as it breaks below the 0.0% level, it's invalid. Okay, so it's important to always remember to pick the lowest point with nothing to the right of your ending point. Okay, that kind of brings us to the end of our recap for the Fibonacci section. So let's get into the introduction for our Elliott wave theory now. Okay, let me know if there are any questions so far. seems like we are all good. So Elliott wave theory is a really popular approach to analyzing financial markets, particularly in trading. So it's based on the idea that price moves in repetitive patterns that's driven by investor psychology. So it's developed by Ralph Nelson Elliott in the 1930s. And the theory suggests that the market movements can be divided into a series of waves that follows a specific pattern. So these waves reflect the alternating dynamics of market optimism. So those would be bullish phases and market pessimism, which would be bearish phases. So it's basically a method of analyzing cycles in the market. And by analyzing these price movements, you can then forecast future market movements. Okay, now let's get into the different types of waves. So the first type of wave that I want to touch on is, so this is what a typical Elliott wave looks like. So it's pretty theoretical, so bear with me in this part. So firstly, we have the impulsive phase or um, impulsive waves, or we even call these motive waves. So um many names for it, but it's basically the parts of the wave that are trending. So Elliott proposed that market trends consist of 5 waves in the direction of the primary trend, followed by 3 corrective waves. So these waves are known as impulse waves and are labeled with numbers 1, 2, 3, 4, and 5. So I have included in bullet points to show you guys just to make it a bit clearer. So wave 1, this is the initial wave in the beginning of the trend. So it's often seen as the beginning of a new move after the previous correction. So this wave, wave 1 is typically not very strong yet. Next, let's take a look at wave 2. Okay, so after the initial rise of wave 1, there's typically a retracement or correction in wave 2. However, wave 2 doesn't usually retrace the entire movement of wave 1. Next, wave 3. So this is often considered to be the most powerful and the extended wave in the sequence. So it tends to be the strongest move in the direction of the trend and is typically longer and more dynamic than waves 1 and 5. Okay, so this impulsive phase, I forgot to mention, we're talking about the numbered phases here in the image that I've included. Okay, next, let's take a look at wave 4. So at the number 4. Following the strong move of wave 3, there's another corrective wave in wave 4. Similar to wave 2, this wave retraces part of the movement of wave 3. So this is all leading us to the final wave 5. So this is the final wave of the trend and represents the last push in the direction of the primary trend. So it's often accompanied by reduced trading volume and can show signs of exhaustion. Okay, so next, let's take a look at the corrective phase and the corrective waves that are part of this corrective phase. So those are the next part that we're going to be talking about are the lettered ABC areas of the wave. Okay, you can take a look in this image as well. It's not so crucial to follow exactly the percentage. So once again, these use Fibonacci levels, which is why I thought it was important to recap on the Fibonacci techniques earlier. But all of these percentages are from Fibonacci and it's important, but not crucial points for you to follow exactly the percentage of the retracement. Anyway, let's get into the corrective waves. So after the 5 impulsive waves are complete, the Elliott wave theory suggests that there will be a 3-wave correction against the primary trend. So these corrective waves are labeled with the letters A, B, and C. So wave A, this is the first corrective wave after the completion of wave 5. So it's a counter trend move against the primary trend. So you can see here wave 5 is upwards. Wave A counters that upward movement. Okay, wave B, after the completion of wave A, there's a partial retracement in the opposite direction, as you can see here. So the partial movement is about 50% or 61.8% of wave A. However, wave B doesn't usually retrace the entire movement of wave A. So again, about 50% or 61.8%. Okay, next we have wave C. So this is the final corrective wave and is often the most dynamic of the 3. So it moves in the direction of the primary trend and can be quite strong. Okay, so once again, the percentages are not crucial to take note of, but it's important to maybe remember some of them. But what's more important is the 3 main rules that I'm going to be talking about in the next slide. Okay, so here are the 3 main rules, and these are really important rules that you should remember. So you can ignore this wave 1, 3, 5 thing here, but 3 main rules that you cannot ignore. Firstly, wave 2 cannot retrace more than 100% of wave 1. Okay, next main rule is wave 3 can never be the shortest of the 3 impulse waves. Okay, so you can see from the image I've included here, wave 3 has to be longer than wave 1 and 2. Next, we're looking at wave 4. Sorry, I misspoke. Main rule 2, wave 3 can never be shortest of the 3 impulse waves. So the 3 impulse waves that we're talking about is 1, 3, and 5. So 1 has to be the shortest. 3 can be longer than 5, but it should not be the shortest. Okay, next. Point 3, wave 4 can never overlap wave 1. So it has to be, just follow the dotted lines here, can never retrace more than the head of wave 1. Okay, the percentage over here, the 1, 3, and 5 is not super important for you to remember. These 3 main rules are more important. Okay, now let's take a look at some of the shapes. So here I've included some examples of entry and some shapes that you can take note of. Once again, there are, if I'm not wrong, more than 50 shapes for Elliott wave and harmonics. So it's a bit difficult for me to include all of the shapes, but I have tried my best to include a couple of important ones for you to take note of. Okay, so here examples of entry. We have the simple M shape and the W shape. Okay, this M and W patterns over here are a bit blurry, but it's basically the same thing. So you can ignore that. So simple M, let's take a look at this. The entry point is between these 2 heads of the M here. And the bottom basically the corners of the shape M. So this is a simple M. When we're looking at an extended M, the extended M tends to be at the back of, or rather the second half of the shape. So it starts from the bigger half here to over here. So any point of this can be considered an entry point. Okay, next, let's take a look at the short formed M. Short form, basically because the second half is shorter than the bigger half here. But for this shape, the entry point is solely at this tip of the M here. If we're looking at W, it's pretty similar here. Excuse me. The simple W will once again take into account all of the corners, and any of these 2 points can be considered an entry. Short formed W, similar to the short formed M, only the tip of the M can be, or the W can be considered an entry. Extended W, the highest point or the highest tip and the middle tip can be considered entries. Okay. So here's an example of a W bottom. So you don't really have to take into account all of these bars. Just really want to highlight the type or the shapes over here. So example of a W bottom here, we have, if you compare here, we're looking at a short form W, and this breakout here is our entry, goes in, and our target or profit target is over here. That's why we say that this point here is your entry, because it's the point of breakout. Okay, if we look at an example of M top, earlier we mentioned, if I go back, we're looking at the short form M, where entry is only here. Same thing, breakout is over here at the tip. So this is our entry, and we're going in for a sell towards our target profit over here. Okay. Okay, if you are a bit confused with the shapes, I've included some images of them labeling the tips of the W patterns and the W patterns over here. Okay. So next type of shape here, we are looking at a bullish godly and a bearish godly. So the rules, in this case, we are kind of going into harmonics over here. But there are a couple of rules for this pattern compared to the previous M and W patterns. So for a bullish godly, the AB leg, which is over here, the highlighted red leg, should retrace about 61.8% of the leg XA. So that's where your Fibonacci levels come in. Then the BC should retrace the 38.2% to about 88.6% of XA. So XA is the first line here. So we're looking at BC now. And then for CD, which is the last leg of this shape, CD is at least a 78.6% retracement of the original leg. So once you have all of those rules that are in line, then you can expect to enter over here, going for buy towards perhaps the A over here or the C. Similarly, if we're looking at the bearish, all of these levels still stand, but instead we're going for a sell instead. Okay. So just another shape for you to kind of take note of if you are interested in harmonics and Elliott wave patterns, because there are a lot of patterns out there. Okay, next we're taking note of a bat shape now. So the main rules of the bat pattern are the AB leg can retrace between 38.2% to 50% of the XA leg. So the AB leg is over here, the second leg here, retrace 38 to 50% of this original leg. BC can retrace 38.2 to 88.6% of this second leg. And the CD leg can retrace up to 88.6% of the original leg. CD leg can also be an extension between 161.8 and 2.618%. So because this is a tick or a Nike tick that we mentioned earlier, a Fibonacci extension, so you could also use the Fibonacci extension over here in this shape as well. And this is the shape that I was talking about, the inverted Nike tick. Yeah, the same thing, the same levels apply, same rules apply here as well. Okay, so it's bearish because we would then be going for a sell here. Bullish because we would then be going for a buy after point D. Okay. And then for our last shapes that I will go through for today, we have the butterfly shape and the crab shape. So let's start off with the butterfly shape first. So we have the 78.6%, the AB has to retrace of the XA. The BC has to retrace 38.2 to about 88.6 of the XA as well. CD has to retrace 161.8 to 261.8 of BC. So once again, this is a Nike tick as well, or the Fibonacci extension. Okay, or the CD can also retrace 127 to 161.8 of the XA. Okay, then you're going for a sell after D. Bullish, you're going for a buy after the D. Bearish, on the other hand, we have the AB retracing 38.2 to 61.8 of XA, and BC over here 38.2 to 88.6 of XA, and CD 224 to 361.8.5 of BC here. Okay, or 161.8 of XA. Okay, so yeah, these are all of the shapes that I will go through for today. Let me know if you guys have any other questions. Like I mentioned earlier, there are a lot of shapes out there. But yeah, I'm just gonna go through a couple in this webinar because this was quite information intensive, I think. I hope you guys are still with me. Okay, let me know if you guys have any other questions. If not, that brings us to the end of our webinar. Thank you guys so much for joining me today, and have a great rest of your week. And yeah, I'll see you guys next week. Bye, guys. Yeah, so these shapes are, let me go back. They are price action, yes. So it's kind of overlapping the price action and harmonics and Elliott wave theory as well. Okay, Jinuka, that's good to hear. Thanks, Stanley. Okay, see you guys next week. Thanks, everyone. Bye, guys. Take care.